having me.
Let's quickly touch on the overall market performance. Around 13 billion rand passing through the market today, so a fair amount of volume. And then we also have positivity coming through from the Eurozone. I know you love looking at headlines. Of course, I'm being sarcastic there. But
we try and stay away from the headlines.
But quite a bit of liquidity from the ECB, which is creating a bit of optimism.
Yeah, there's some good news coming out of the US as well. We saw those fourth quarter numbers that came out yesterday and today. And then obviously the ECB loan, the 530 billion euros that they're lending the banks, that's obviously caused positive sentiment. We also seen some good results. I think we had Nedbank out today, which had very nice results. And we've seen Standard Bank, ABSA and FirstRand out a few days ago, so that's also adding to the positive.
So you're not paying attention to Moody's downgrading banks today?
If you're going to look at Moody's, these are the same guys that I think had a AAA rating on Bear Stearns a week before, or an A rating rather on Bear Stearns a week before they went bust, and a AAA rating on Greece not so long ago. So I don't think you want to pay too much attention to what any rating agency says at the moment.
So let's just touch on Nedbank. I know that it's one of the stocks that you actually look at, and it seems that the company has done a significant turnaround within the retail banking space, and this is what one of the biggest issues were for Nedbank a couple of years ago.
Yeah, I think they're very nice results. Their headline earnings per share was up about 25%. I think you've seen the theme coming through from all the banks. Their non-interest revenues up, advances are increasing slightly, they're maintaining their costs nicely, and their credit losses are down. And that's the theme that we've seen out of FirstRand and ABSA as well. The retail section was obviously the star performer. I think about 2 years ago they were making a loss, and we've seen what they've done today. Yeah. So yeah, it's a very nice set of results. I think on a price to book of 1.5 times, Nedbank still looks quite attractive. It's been the top performing banking stock over the last year, so it's up about 30%. So it's been a very good performer for us.
It's up at around 0.7%. The truth is, within the banking space, competition is rife. We saw what FirstRand also is up to with regards to F&B. We know that Capitec is actually making very strong headway within the low income space. ABSA is doing quite well. It seems that they're not delving too much in the unsecured loan space. Do you think that Nedbank is very well fitted and has a strong strategy in terms of what it wants its book to look like?
I'm not sure. I think Nedbank has been penalised in the past, in particular because it hasn't been in Africa, and that's where we've seen a lot of the other banks moving. Standard Bank obviously got hurt there. Nedbank's ROE, if you look at it, is 15%. When you compare it to some of the other banks, their ROE is closer to 20%. So whether they've got that strategy right, they probably deserve to trade in a slight discount to the other banks. But time will tell. I think we think a fair value price to book for it is about 2 times, sitting at 1.5. So we think it's still got some way to go. Should it be priced like the other banks, it might deserve to trade in a bit of a discount.
Interesting. We've got FirstRand at the bottom of the top 40 today, down around 1.4%, and out with some strong results in yesterday's session.
Yeah, I couldn't comment on why they're the worst performing share in the top 40. Their results were very nice. We saw RMB's results, which obviously flow from FirstRand's, and they were also exceptionally good. So I can't comment on why, or I wouldn't want to have it a guess as to why they're the worst performing share in the top 40 today. Maybe someone's paying attention to Moody's. I don't know.
Okay, well, what about Woolies, which is up at the top of the top 40, up almost 2.5%, and then followed by Implats, which is sitting up around 2%, and worries and woes continuing in Zimbabwe, and then rehiring some of the people that were retrenched. 2 billion rand being lost at Implats at the Rustenburg mine. So a lot of negativity that has come through. Is it offering value at these levels?
Implats is probably our platinum stock, would be our choice platinum stock at the moment. We've got exposures to Amplats through Anglo American, which has been it's been a non-performing asset over the past year. And we've seen that Anglo American are going to go and review that now. Implats, I think, it looks fairly attractive when you're comparing it to the other platinum stocks. Whether we're going to go into it, we don't hold any precious metals, gold or platinum at the moment. Direct exposure, that is.
Why is that?
How long do you have? Gold, it's incredibly difficult for a value manager to try and get to try and value precious metals, gold in particular, and platinum. They're so cyclical. The usual arguments apply here. You know, you've got your deep, expensive mines who've had the strikes going on, your interference, political interference.
But they're offering such an attractive PE, doesn't it? I know as a value manager that should attract you somewhat.
It's attractive today. In 6 months' time, it probably won't be when the platinum price falls to 214.
Let's touch on AFGRI. We have half-year headline earnings per share down around 17%. Tough conditions, the company says, low grain storage volumes, and this is what led to the decline.
Yeah, record maize prices have helped their top line. However, it also hurt their raw material and feed costs. That's where they got hit the worst. Also, they've sold their book, their farmers' debtors book, which would have hurt their interest income. So those were the main causes that you've seen that headline earnings per share down at 17%. However, it doesn't look too expensive at these levels. PE of 13 and a dividend yield of 4%. They've been a very good dividend yield payer, or dividend payer rather, over the past few years. So it's.
So you're saying the stock is attractive at this stage, and saying
it's interesting. It's not at screaming buy levels, but then again, it's not priced as expensive as some other sectors within the market.
All right, so let's, after sitting at R5.89, let's touch on Grindrod. Headline earnings per share decreasing by 41% and earnings falling by around 32% as well for the year ended December. Weak shipping market. The company has been, I know that this is one of the stocks that you own. It's sitting at exactly 15 Rand and it's up around 1.4% today. So despite this negative news, it seems that a bit of optimism is coming from the share price.
It's a share that we've held for a very long time now. Unfortunately, it's had a very tough few years. It's a shipping market. There's oversupply of ships in the market, which has pushed your shipping rates down. The bank, their logistics and their trading divisions, however, did actually quite well. This is a very nice long-term story. If you want exposure to Africa, forget your ShopRites, forget your Massmarts. This is where you want to be. Although the headline earnings per share were down 40%, it wasn't as bad as the market expected. We thought it was going to come in worse than 40%. So that might have been the reason for the uptick in the share price. But if you look at your Africa and Asia trade, it sits at about 300 billion today. And by 2020, it's expected to be at about 1.5 trillion.
So you're optimistic about the shipping industry?
Yeah. So I think a lot of ships are going into retirement now. There's been an oversupply over the past few years. They're expecting that oversupply to disappear in the next couple of years, and I think we'll see a recovery. It's priced for recovery.
Let's touch on construction. I know that Cannon Asset Managers went into it far too early, but hopefully this is the year where we'll actually start seeing the promises come through. There's one specific stock that I know a lot of investors are worried about, is Murray & Roberts, and that company out with diluted headline loss per share of 210 cents for the first half of the 2012 financial year. The company, however, is very upbeat. Should it be?
I think if you look at the outlook, I haven't looked at the Murray & Roberts results, but looking at the outlook of the other construction companies, Wilson Valley Homes, Group 5, they're also quite positive on the outlook. They think the corner has been turned. We see the infrastructure spend that is supposedly coming through now when you listen to the budget speech. So order books are up. Wilson Valley Homes, if you look, they had a very nice order book. It increased quite a lot. So hopefully the corner has been turned. Time will tell. We've been singing this tune for 2 years now. But a year ago they said 2013 is the year that we're going to see the recovery come. Hopefully equity markets are a lead indicator. So hopefully this year we'll see some decent returns coming from them.